Thanks for visiting my channel. My name is Tanveer Chaudhary. I'm an IT professional, a certified financial planner, and real estate investor. I've been able to become financially free in my early 40s by building an 8-figure real estate portfolio by simply purchasing properties, renting them out, and holding them for long term. My goal of this channel is to help fellow Canadians achieve the same through financial education and investing in real estate. Since this is RRSP season in Canada, I thought I'll make series of videos discussing different RRSP strategies in the month of February. Today's topic is 10 things to remember about RRSPs. This is the first video in the RRSP series. Today I won't be talking about RRSP withdrawals, spousal RRSPs, and RRSP mortgages. In the coming weeks, I'll be making 3 different videos on these 3 topics, so keep an eye out for them by subscribing to this channel. Before we get started, let's talk about what RRSP stands for. RRSP stands for Registered Retirement Savings Plan, and it's designed for Canadian taxpayers to save money for retirement. That's the primary purpose of this account. First thing to remember about RRSPs is that RRSP contributions are tax deductible, which means you contribute to this plan with pre-tax dollars. Money grows tax sheltered within this plan, and taxes are deferred until you withdraw money from this plan. RRSP contributions and growth on RRSP contribution doesn't stay tax-free forever, unlike TFSA. Idea is that when you withdraw money from RRSP in retirement, you will have lower income, so you'll be paying less tax than you originally saved. You'll also be paying tax on the RRSP withdrawal in retirement with discounted dollar, because the dollar you save today is worth a lot more than dollars you pay on taxes 20 to 30 years from now due to inflation. Canada has a progressive tax system, therefore has tax brackets based on your income level. More money you make, more taxes you pay. Therefore, you can optimize your RRSP contribution to lower your tax bracket and maximize your tax deductions. Second thing to remember about RRSP contributions is that there is a limit of 18% of your previous year earned income, which you can contribute to your RRSP plan at a maximum of $29,210 for the tax year 2022. RRSP contribution deadline for the tax year 2022 is March 1st, 2023. If you make RRSP contribution by March 1st, 2023, you can deduct that RRSP contribution against the income you had in the tax year 2022. But your RRSP contribution limit was calculated based on the income you had in year 2021. Because RRSP contribution limit calculations are always 1 year behind, therefore should be listed on your notice of assessment you receive from CRA for the tax year 2021. If you have a registered pension plan with your employer, any pension plan contribution will reduce your RRSP contribution limit because pension plan contributions are same as RRSP contributions. It's called pension adjustment, and it's usually listed on the box 52 of your T4 slip you received from your employer. Your final RRSP contribution limit should be listed on your notice of assessment for the previous tax year, which already factors in the pension adjustment, so you don't have to make that calculation yourself. Just use the RRSP contribution limit listed on your notice of assessment to plan your RRSP contributions. Third thing to remember about RRSPs is the contribution room. Any year you don't make contribution to RRSPs, your contribution limit carries forward indefinitely, and it should be listed on your notice of assessment. You can use the carried forward contribution room anytime before the end of the year you turn 71. You can also catch up by making lump sum RRSP contribution in the year you have high income or you selling an investment property and have capital gains. If you borrow RRSP contributions using RRSP loan, since the tax on the RRSP loan is not tax deductible, therefore it's advisable to try to pay off the RRSP loan within the current tax year. There is another RRSP strategy I like to mention here. If you are expecting a refund and have some cash in hand to contribute, there is a formula to calculate the amount of RRSP loan required to top up your cash in hand to match it up with the expected refund. This way you can pay off the RRSP loan entirely with the refund, and there is no loan payments to make in the future. I'll put the formula on the screen how to calculate RRSP loan required to match up with the refund. Best time to use this strategy is February before the RRSP deadline, using RRSP loan with the first loan payment being deferred for 3 months, so you can receive the refund before the first RRSP loan payment is due. This is also called RRSP gross up strategy. 4 things to remember about RRSP contribution is that there is a lifetime over contribution limit of $2,000. There is no penalty on the first $2,000 of over contribution, but anything above that amount will have 1% per month penalty or 12% a year. CRA also allows to withdraw the excess contribution. You will need to show that excess contribution was an honest mistake on your part. 5th things to remember that any contribution you make to your RRSP plan, you don't have to deduct the entire contribution in the current year. You can deduct that contribution in the future year when you're expecting higher employment income or selling an investment real estate and have capital gains. 6th thing to remember about RRSP is that you can have as many RRSP plans as you like. You can move funds in the plans between different institutions, either by converting into cash or in kind. When you move funds in the RRSP plans between different financial institutions, it stays within the same RRSP cloud. Money never leaves the plan, and it's not considered RRSP withdrawals. Therefore, there is no tax triggered. All financial institutions report any RRSP contributions you make at different financial institutions to CRA, so your notice of assessment should have the consolidated contribution room available for the next tax year. 7th thing to remember about RRSPs is the type of eligible investments you can hold within your RRSP plan. Eligible investments for RRSP plans include stocks, bonds, ETFs, mutual funds, buy and sell call options, where you can write covered calls on the shares you already own within your plan, and residential mortgages. Non-eligible RRSP investments include physical gold or gold bullion, piece of land, or naked call and put options where you don't own the underlying stock within your RRSP plan. These things are prohibited due to the speculative nature of these investments. 8th thing to remember about RRSPs that you should consider contributing to group RRSPs if offered by your employer. Even if your employer is not contributing to your group RRSP plan, take advantage of it because your employer usually negotiates very low management fees with the investment firms. Group RRSP offered by your employer offers some great investment options like portfolio target funds, where they perform automatic rebalancing for proper asset allocation. Another big benefit of group RRSP is that when you contribute to group RRSP through payroll deduction, you're contributing with the pre-tax dollars and not with the after-tax dollars. You'll see less money coming off of your paycheck, and this will improve your cash flow. Let me give you an example. Let's say you're contributing $200 bi-weekly to your group RRSP at work, and if you are in a 35% tax bracket, you'll see $130 coming off your paycheck. This also means that you will not be getting a tax refund at the end of the year since you'll be contributing with pre-tax dollars through payroll deduction. This is a good tax strategy since you're not giving CRA the interest-free loan until you get the refund. 9th thing to consider about RRSP is spousal RRSPs. If you have a spouse which doesn't work or have lower income, watch out for the video on spousal RRSPs coming out next week as part 2 of this RRSP series. I'll be giving you tips on spousal RRSPs which you might not have heard anywhere else. 10th thing is to consider self-directed RRSPs. If you like to manage your own investments, buy and sell stocks, ETFs, mutual funds, write covered calls on the stocks you already own within your RRSP plan. You will also need self-directed RRSP if you like to lend money to yourself as a personal mortgage, or you want to lend money in your RRSP to someone else as a mortgage. RRSP mortgage video is coming out in next couple of weeks as part 4 of this RRSP series. That's all for this video. Please remember to watch 3 more videos coming out in the coming weeks about RRSP withdrawals, spousal RRSPs, and RRSP mortgage. That's all for this video. If you think information like this can help someone, please share this video. Also like, comment below and subscribe. Thanks for watching and see you in the next video.